Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Wednesday, December 9th, 2020, and I'm pre-recording this Trading Places Live for Thursday, December 10th. Futures are relatively flat after we saw some selling on Wednesday. Going to get into all of that in just a minute. Let's go through your agenda for today. We got the daily market recap. Then we'll jump into talking technically. I want to look at that growth versus value relationship. That's one that I watch pretty closely, trying to watch to see the rotation. We've seen a lot back and forth, a little sparring back and forth between growth and value, but value took quite a punch today. We'll talk about that a bit. Then we'll get into sector spotlight. I want to talk about the XLK, which is technology sector. This is a group that was challenging some resistance. I'll show you that on the chart, get into a little bit of that. Take a look at chart lists, the strong earnings chart list. I'll show you one glance at our chart list. I think you'll be able to decipher what happened in the market just by taking a quick look there. Excuse me. Then we'll get into the earnings spotlight. Got a couple of companies reported after the bell today, and then a couple of them coming out tomorrow. One, a big software company, Adobe. So we'll try to take a look at those charts, and then we'll wrap up with the three you must see. So let's go ahead and turn our attention first to the website, our website at earningsbeats.com. You can see opportunity to sign up for our free newsletter. Just type in your name, email address there, hit the subscribe button. Love to have you. It's published 3 times a week, Mondays, Wednesdays, Fridays, no credit card required, and you may unsubscribe at any time. Also, we'd love to have you try our service, 30 days. It's $7, but it's fully refundable. So you sign up for $7. Within a week, we'll have it credited back to your credit card. So there'll be no cost for a month. And then you can check out our portfolios and all the work that we do. Portfolios here were not updated as of today's close. And I can tell you there were some hits because of some of the growth stocks that were down. So that has not been updated yet on here. Probably 2 or 3 percentage points on perhaps a couple of these portfolios. A couple of them took pretty good hits today. So anyhow, we should have that updated for you at some point on Thursday. But just want to let you know that this did not include, and the S&P 500 doesn't include the loss that was sustained on Wednesday as well. All right, let's move on. I want to go through the recap, daily market recap. Let's take a look at what happened. I don't think that we put in any kind of a significant top. There are some areas of the market and certainly some industry groups and perhaps some individual stocks that may have put in some tops, but I think we're going to continue to see rotation. Nonetheless, we did see weakness on the Dow, down 105 points, the S&P 500 down 29, NASDAQ down almost 2% today, down 243 points. So on a relative basis, definitely a big hit there, but you can see all three of these indices are all trading above the 20-day moving average, and even the NASDAQ, which took the biggest hit. If you look at that PPO line, very, very strong coming off of a center line test. I'd be surprised to see us go much below the 20-day moving average. I'm not sure we'll see a close below the 20-day. So if we do get a little bit more weakness, could be setting up short-term opportunity. The S&P 400 mid caps did take it on the chin as well, but not nearly as much as the NASDAQ or the Dow or S&P 500, down 0.4%. Small caps only down 0.1%. So even with the selling today, small caps held up well. So their relative strength just continues to build. Energy, once again, on top of the sector leaderboard. We seem to see it either on the top or the bottom just about every day. So why should Wednesday be any different? Energy up about 0.2%, close to 0.25%. Industrials up the same percentage. Both looking pretty good on their charts, trading above the 20-day moving average, which is rising, and above the 50-day. So the configuration there looks pretty good. Technology took a little bit of a hit. Actually had sent in, I think it was in the daily market report I sent to our Earnings Beats members yesterday. Looking at technology, we were right up against that September high. And so obviously there's always a question, are you going to get through? Are you going to pull back that first time? Well, we got our answer today. Technology down almost 2% today, and that was the main reason why we saw the NASDAQ down so much. pretty big hit here on the technology group. Home improvements had a pretty strong day, up about 2.6%. You can see testing a lot of price support around 555, 560. Nice bounce, got up to test that declining 20-day moving average. We'll see if we can get through that on Thursday. If we don't and we fail and go back down and fail to hold the support level, it would not be good for the group. Autos, worst performing industry group today, down 5.5%. Tesla finally took a little bit of, took one day off, but Tesla actually looks kind of interesting to me, and that's going to be one of the stocks I look for or look at the end of the show in the 3 you must see. So I'll hold my thoughts till then. But auto stocks in general were down today, and you can see down 5.5%, pretty good hit. 10-year Treasury yield. Well, first off, there wasn't a whole lot out today in terms of news, so we did see a little bit of a jump in the yield, up about 3 basis points, 0.94%. As we look ahead to Thursday, November CPI will be out, looking for just a slight uptick. October was flat, 0.0%. Looking for November CPI to tick up to 0.1% rise. November core CPI, which was flat in October, is looking to tick up to 0.2%. So a little bit of tick higher in inflation expected in the morning. I'm not sure if we're going to see it, but I don't know. We'll wait. I guess when the numbers come out, we'll know. Initial jobless claims last week was down to 712,000. It is expected to jump back up a little bit this week to 724,000. All of that will be out at 8:30 in the morning, and we'll go from there. As far as the yield, I mean, I think that we continue to be in this little channel here to the upside. I think resistance is pretty clear at this point, just around that 0.95. And I think psychologically getting back above 1%. So I'm going to say 0.95 to 1% is your range to the upside. To the downside, I still think this gap that was created from the first piece of positive vaccine news out of Pfizer back on November 9th, we gapped up from 0.82. You can see the 50-day moving average now has moved above that to 0.83. And if you look back, since we started this uptrend and really since the beginning of September, we haven't seen a close below the 50-day. So I think you've got the 50-day at 0.83. You got gap support 0.82. And that was created from the vaccine news. It seems like the market is, taking that news into account. That's what's causing a lot of the churn, a lot of the rotation. And I'd be surprised to see the 10-year Treasury yield go back down below that level. So that's the range for me right now. I'm going to say 0.82 to about 1.0. Let's move on to talking technically. I want to talk a little bit about the growth versus value proposition here. And, back in September, and this is when, everything was rolling along, the market was very strong. NASDAQ particularly was very strong, and growth was leading value. And we got to the early part of September. We had some sentiment issues. I remember writing an article, I think it was on September 3rd, saying the market looked like it was toppy. Wouldn't be surprised to see some selling, and we saw some selling. Now, we're going through this process of rotation. And when I look at this chart, I don't have it going back quite far enough, but you have to trust me on this. We had a series of higher highs and higher lows on this relative chart. So you can see this one, we pulled back to about 1.54. We break out, we go to 1.82. We pull back to 1.69, which tests that prior high. And then we go up, we put in a new high. So at this point now, in this series of higher highs and higher lows, we've got this higher low and we've got this higher high. And everything has been in the middle of this range. We've gone back down. We've tested this 1.69 level, haven't closed below it, haven't gotten back up anywhere near that September high up around 1.90. And it kind of looks like we're leaning, and rolling over here. 1.69 is a big level in the near term because, again, I think that this short to intermediate term uptrend in the IWF, IWD is somewhat reliant on this 1.69 level holding. That was a prior high that becomes support once we break through. We've gone down. We've tested it twice. No need to break below it, or else the short to intermediate term uptrend falls apart. And that could lead to some more selling of some of the growth stocks that have been leading the market in 2020. So that's the significance, is if that trend line, or if this support line, relative support line, breaks, then we could see some more selling. And I think that's really important to keep in mind. Now, I don't look for the overall market to just sell off. I really don't. I think we're going to go sideways. I've said the S&P 500 recently. I've talked to our members at Earnings Beats. I feel like, maybe we could see a 2, maybe possibly 3% move to the downside. I'm just not looking for much. I think we continue to move higher into year end, but we could see some rotation. And historically, it's important to point out that if you're going to see weakness in December, historically, it comes between the 6th and the 15th of the month. So today was the 9th. So we're right in the middle. And between the 6th and the 15th, the 11th to the 15th tends to be the worst part of this period. And that's what we've got to look ahead to. And another reason to pay attention, because if we lose this support area, relative support area, we could see some more short-term selling in some of those growth areas. I don't believe it's going to be this massive sell-off. I think it'll create some tremendous opportunities as we head toward the end of the year and into the beginning of next year. I expect a lot of these growth stocks are going to come roaring back for earnings. Because I think earnings are going to be strong. I think that they're going to have good things to say about 2021. And with interest rates near historic lows, I think their growth stories are going to remain alive. And I think the low interest rate environment is going to create some higher valuations than what we've already seen. So I do believe once we get past this little patch, I think we're going to have a really strong period. The question is, if we lose this level, how far do we go down? If you're trading growth stocks, I'd be very careful in the near term if this level it gives way. Even today, we saw a lot of those growth stocks giving back some pretty hefty, some big portions of their recent gains. And that could accelerate in the near term. I'm going to say for maybe another few days to a week or so. And then I would look for things to stabilize. And as we get close to the end of the year, I think things will pick back up again. Anyway, this is the hourly chart. So over the last 9 months. Now I'm going to take you to a longer chart on the IWF IWD to give you perspective. So what we've been looking at is basically this move right in here, moving up and then rolling over. That's all we saw on this chart. So back in March. So if you look at the weekly chart, we're going back only to about right here. So here's the movement up. Looks like we're rolling over, and here we move back down. Now on a weekly chart, it's almost like we need to pull back. I mean, it was such a huge relative run in 2020 with money pouring into growth stocks that a little bit of rotation isn't a bad thing. We want everything to participate in the market. So I think after we pull back and maybe we get this 50-week test, maybe even dip below it. I don't know, maybe you could draw a trend line. Maybe it goes down, even further. I don't think it's going to. I'd probably be, start looking for adding trading pieces on the long side if that's what you're looking for as we get down to the 50-week moving average. If we get down there, again, I want to emphasize 1.69. We have not broken this uptrend until we close below 1.69. I've actually maybe 1.685, something like that. All right, last thing I want to talk about with the IWF IWD is the seasonality. So here's the IWF versus the IWD. And I want you to take a look at December, because IWF, this is percentage of months in which IWF outperforms the IWD this century. Only 40% of Decembers have we seen growth stocks outperform value stocks. And as you look across all the calendar months, that's only challenged by March, which also is 40%. Everything else is at least 50% or higher. So growth tends to lead the market, tends to do better than value. But December, and look at the average underperformance. This isn't the IWF averaging going down by 0.9% in the month of December. It's averaging underperforming the IWD by 0.9%. So almost 1 full percentage point within the month of December. That's the average. So obviously there's some years where it's a lot worse. Some years, obviously, better. 40% of the Decembers, we've been better. But as you look across here at the averages, you can see that nothing is even close to minus 0.9. December is the month you got to be careful about, or beware of in terms of technology stocks, growth stocks, because I think it's also the XLK. I want to move on, but let's take a look at the XLK versus the S&P 500, because I believe that it's also a little bit of a rough period here. I mean, yeah, you can see December, the technology group outperforms the S&P 500 only 35% of Decembers this century, and the average underperformance is 0.7%, which when you look across here is the worst of the year. So, and I'm going to show you a chart list, and just keep this chart in mind, talking about technology. In fact, the next couple of segments, I want to talk some more about technology. So let's move on. Let's move into the sector spotlight. Let's bring up technology chart. So I'm going to annotate this for you first, because if you see right here, this is what I was talking about to members yesterday. There was the high in September, and we were right on it. Now, the S&P 500 is broken out. The Dow Jones is broken out. The NASDAQ's broken out. Everything's broken out. Major indices are all breaking out. Technology had not yet broken out. It speaks to the rotation that I've been talking about. Money has been rotating away from technology. Even though we were on the verge of breaking out, we didn't make the breakout. And because we didn't make the breakout and the major indices have made the breakout, it's kind of telling us that we're seeing relative weakness in technology shares. Another way to look at this, and by the way, if we can't get through there and we pull back, first thing I would be looking for is this 20-day test. All right. If we're truly trending higher, we've been holding this 20-day now for about the last 5 weeks. If we're truly trending higher, if we get a little weakness, even intraday, move below that 20-day, let's see if buyers come back in and see if we can close back above the 20-day. That would be really important, because that would continue to suggest we're trending higher. And ultimately, we should look for that breakout. If we fail to hold that 20-day moving average, then I think we have equal highs, we have equal lows. We're simply sideways consolidating. When your moving averages don't hold as support, you have to start thinking sideways consolidation. When they hold as support, you have to start thinking uptrend. So I think that's going to be really important here in the near term, is what happens if we do see some more weakness tomorrow or Friday or next week. What happens here with the XLK? Do we hold on to the 20-day moving average? All right. Let's see. What else do we have? Well, let's take a look at a different angle with technology. Now, here's the relative strength of technology going back the last 10 years. This is a weekly chart. So here is technology relative to the S&P 500. Now, when we look at this daily chart, we say, oh, well, we haven't broken out. We're not performing very well on a relative basis. Keep things in context. Perspective. It's all about perspective. Look at this move over the last 2 years. Technology is crushing. It's literally putting the S&P 500 on its back and carrying it higher. And it's because technology shares, many of the companies in technology can grow their earnings very rapidly. Many of them can be very nimble, as we saw with the pandemic. Certain areas of technology did extremely well during the pandemic. So these companies can be very nimble. They didn't get hurt nearly as bad during, the stay-at-home orders and a lot of the restrictions that were placed on our economy. And so we had this huge run. So keep this in mind. I mean, now you can see the relative PPO is dropping. This doesn't really mean a whole lot. I know there are a lot of technicians that really get bent out of shape when the PPO is moving down like this. I'm not one of them. I just want to make sure I'm above the zero line. When I start moving below the zero line, I start getting a little nervous. There was the trade war back in 2018, and we came right back up, went positive again, and look what happened. It led us to the upside. Plenty of times in here, you can see PPOs that were turning down, but technology continued to lead the whole time. So This is a secondary indicator. Here's price action is your primary indicator. And this is relative price action, which is maybe just a little notch below absolute price action. I want to know what's going on in terms of relative strength. So technology has been very strong. And even if we do have a little bit of selling here in December, don't ignore the big picture here. These are companies that can grow their earnings very rapidly. In a low interest rate environment, they're going to command high PE multiples. Any kind of selling in the near term, and if you're a trader and you've got cash available or you're looking for shares in technology, I think you should be licking your chops as these stocks sell off and pull back, especially as we get closer to January. Many of these technology companies have a history of not doing well in the final month of a calendar quarter, right before you get that pre-earnings run up. And I think we're going to get a pre-earnings run up in many of these stocks in January. So anyway, be prepared. Whatever that means. If you're holding on for the longer term, I'm not concerned about what's going on with growth stocks versus value. I think that we're going through a period of little rotation. I think growth will lead again. I just think the environment's going to be strong for growth stocks. But I think the environment's going to be great for all stocks. Just which ones lead from time to time. That's what we should be looking for. Sorry. All right, let's move on. Next up, I want to go into, let's go ahead and jump into the chart list. All right, so here is my strong earnings chart list. You know, we talked about technology being weak. I sorted this chart list. This has got 499 companies that have beaten Wall Street estimates in their most recent quarter as to both revenues and earnings per share. That's what is, and they're technically, there's something technically I like about them. Either they're in a strong group or the stock has been very strong, maybe relative to its peers, maybe relative to the S&P. But technically there's something going on. Maybe I like the volume that accompanied the gap up with earnings. Maybe a stock was in an uptrend, a gap down with earnings, but I still like the overall picture. But bottom line, all of these stocks on our strong earnings chart list have gone through quite a process where I've looked at the earnings, I've looked at the revenue, I've looked at their volume to make sure they're liquid. We're not going to put any illiquid stocks on here. So get a company came out blowout earnings. I look at the chart and they went up on 100,000 shares. That's not going to impress me. So strong fundamentals, liquid, and then something technically that I like as well. 499 charts on here, 499 stocks on this chart list. Anyway, here was, I sorted the chart list, and that's a cool feature at StockCharts. If you don't use this, you should. If you have a watch list or something that you've got a bunch of stocks in, you can just come into this and view it summary form. And then just click on one of these columns and it'll sort it for you. So you can get a really quick look at what's going on. So here, I've just sorted based on the worst performers today. This is the period, intraday. I could do week, I could do month. You got a lot of different choices here, year to date, 1 year, whatever. I just did intraday. And when you look down this list, there are obviously a lot of stocks that got hit very hard. These are good fundamental companies that were hit hard today. And a lot of them probably needed it. Many of these stocks were just going up day after day after day. I mean, look at a stock like Cloudflare, NET. I mean, this stock was $32 in September, went up to almost 85. Should we be that upset that it's down 7% today? I mean, I guess if you bought it yesterday, you'd be upset. But in this whole scheme of things, big picture, this is a great looking chart. So we got to be careful. All right. So when I look down this list here, look at all the technology names. Got a few healthcare thrown in, maybe a couple discretionary, but essentially it is like littered with technology names. And look, I mean, I'm just going down technology. I mean, it's just over and over and over again. This was the group that was getting hit today. Technology was right at that high in September. It didn't get through. You had some folks taking profits. I mean, that's what was going on. Do I think that's the start of a bear market? No, I don't. I don't think it's anything like that. We need a whole lot more selling before I would turn bearish. And I'd have to see other signals in the market as well, not just short-term selling. I'm not seeing those signals. So we're getting some profit taking. Again, this time of December, this is what we typically see. We also typically see growth stocks underperform value. We typically see technology underperform the S&P 500. And that's what all this selling was about today. So I wouldn't read too much into it. All right, let's move on to earnings. Two stocks reported after the bell, worth noting. One is RH. This is a home improvement company. And not just any home improvement company. This has been a stock that's been leading home improvement. It's been a really strong performer in this group. They reported after the bell, $6.20 earnings. Market was expecting $5.42, and it was up about 0.5% after hours. It did have big volume on Wednesday, and it did have a little bit of a reversal there. So now that earnings come out, if we don't, rally early in the morning, I suspect we're going to see a sell-off, probably down to the 20-day moving average, which is at 441. I wouldn't be surprised to see 5 or 6% move down. And at that point, you've got a leader in home improvements. Might want to consider a position there. I don't like to chase. And if you don't get the breakout with earnings, I think you're going to see some profit taking. Just my gut feeling. VRNT, this is Verint. And this is in the software space, I believe. Verint Systems, yeah, software. Couple of big red candles, heavy volume recently. They did beat $1.02 versus 79 cents. Stock's up $2.23% after hours, but that is not going to be enough to clear these recent highs. AD line looks pretty good, though. I will hand it to the stock. Looks good. Uptrend's pretty good. It's been a pretty good recent relative performer versus software. It was not, but then starting back in here, probably with the last earnings report and the gap up and the pullback, and then this huge rally afterwards, that's where we're starting to see relative strength. So this is a stock that's showing strength versus its software peers. So I do like that. But it may need some more consolidation because it has run quite a bit just prior to its earnings. Now, I mentioned Adobe. Adobe reports in the morning. Relative strength, I'm a little nervous, and this is a big name in that space, so be watching for this one. And then Ciena, which is in the telecom equipment area, and this has not been a very good performer. So I'm not really expecting a whole lot out of Ciena. All right, let's move on to our final three you must see. I'm going to start off with Band. I don't know if you can see this. I've pointed this out before, but I see a topping head and shoulder pattern, and I'm not calling for too many tops in the market, but I see left shoulder, neckline, head, neckline, right shoulder with potentially a reversing candle today. I'd be careful, especially if this stock closes below the 20-day, and then really if it closes below $140. That's where it would really get my attention. Next up, Monster. Just want to show you among the soft drink stocks, it is trying to break out. It's trending above that 20-day. It's been holding the 20-day. AD line looks pretty good. And this is a pretty good performer relative to soft drinks. Unfortunately, soft drinks haven't been very good. And then the last one I wanted to show you is the one I talked about at the beginning of the show, Tesla. Tesla, we've had this huge run up. I think we could be maybe topping a little bit similar to what we saw back in July, where we had volume pickup after a big run, and then we couldn't get back through that high for a few weeks. I think that's what we could see with Tesla here. I'd be a little careful. Maybe think about taking some profits if you've been in it. Anyway, that's it for me. Have a great rest of your day on Thursday, and I'll be back next week on Monday over at Earnings Beats for your next Trading Places Live. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.